Hi, this is Marvin. This is a video discussing on an introduction to the mutual funds. This module is comes under financial markets and operations. The syllabus for this module is as provided. The content is all about the elementary parts of mutual fund. This video will possibly answer what is mutual fund and the concepts like NAV and AUM. Before moving on to the meaning of mutual fund, we have to understand what is investment. Investment is nothing but commitment of your current resources at present in expectation of getting more or enhanced resources at future. So investment basically have two elements, that is deploying the current resources presently and expecting for future return. In financial investment, your deployment of resources at present is on financial asset. That means in financial investment, you are committing your money in financial asset in expectation of getting return. So in financial investment, the return can be of two formats. It can be either income or capital gains or combination of both. So income can be in the form of dividend and interest. So for instance, if you are investing in fixed deposit, and you may be getting interest. And if you are getting dividend for your equity share investment, that is a income return. While take the case of the market price changes in the shares, for instance, rupees 10 share changes to rupees 11. That 1 rupee gain is known as capital gain or capital appreciation. So the return can be in two formats basically for financial investment. It depends upon your investment and the time. Now, the heart of any financial investment is the investment objective. That means investment objective means the purpose for which you are investing or simply why you are investing. The answer may be I am investing for capital protection or preservation, or I am investing for repaying my debt, for children's education, etc. etc. So why, for what purpose the return generated from your financial investment is used for? That's the investment objective. Now we can see the definition of mutual fund. It's provided by SEBI. And first of all, in India, SEBI controls or regulates the mutual funds in India. A descriptive and well maintained definition is provided by SEBI for mutual funds. And we can look upon a simpler definition. So, mutual fund is a trust that collects the money from the investors who have or who share a common financial objective or goals and invest the proceeds in different asset classes as defined by the investment objective. And please appreciate the fact that mutual fund and mutual fund scheme, you have to differentiate these two terms. Mutual fund is a financial intermediary or a financial institution, and this financial institution manages various mutual fund schemes. For instance, SBI Mutual Fund is a mutual fund institution formed under Indian Trust Act 1882. So this mutual fund institution in the format of trust may be managing 10 or 20 mutual fund schemes. So anyway, mutual fund is a trust that collects the money from the public who have a common financial goal. And for every mutual fund schemes, there will be a distinctive investment or financial objective. Accordingly, the investment is made by the mutual fund. So if you say that I am investing rupees 500 in a mutual fund means that you are actually buying or investing in the units of a particular mutual fund scheme, not in the mutual fund. Mutual fund is actually is a institution in the format of trust. And in India, a lot of mutual fund institutions are there, and some of examples are provided here. Anyway, we can see the functional model of mutual fund investment in India or any scenario. Basically, you can see that in the image, there are a lot of investors in the public, and a mutual fund institution, here an example, Nippon India Mutual Fund Institution will collect the money from the investors or pools the money from the investors who have a common goal, say for instance, creating a retirement corpus. This money collected from the common objective having investors is collected by Nippon India, and there are certain fund managers employed by this mutual fund institution, and these fund managers will use this money to invest in various portfolio of financial assets. Actually, these fund managers are uh, experts in investment management or investing, and these fund managers on behalf of these investors will invest in various financial assets, and after meeting certain commission and expenses related to investment, rest returns are given back to the investors if there are any returns in intact. So that is the basic process behind mutual fund investment. Now you can see a simpler model of mutual fund investment. Suppose consider a mutual fund scheme XYZ is managed by a particular mutual fund house, say for instance Nippon India Mutual Fund, and Nippon India Mutual Fund House collect money from three persons under a mutual fund scheme XYZ, and person A have provided rupees 500, B have provided 200, and C have provided 300. So in total, the asset size of that particular mutual fund scheme is rupees 1000, and technically we call that as assets under management. And this rupees 1000 is in turn used by fund managers and invested in various portfolio of assets, financial assets. So suppose consider the scenario, if a particular unit or the face value of a unit is rupees 10, then how many total number of units can be produced from the asset size? Here the asset size is 1000 and the unit price is 10. So in 10 we can say 1000 divided by 100, we can get a total number of units of 100. So how much units may be getting for Mr. A uh, in the mutual fund holdings in the particular XYZ scheme? The answer is he have invested rupees 500 and divided by 10, that is the face value of one unit, he may be getting 50 units. Likewise, in the previous example, B may be getting 20 units, 200 by 10, and likewise, investor C may be getting 30 units. Now, you have to appreciate the fact that in India, mutual fund is established under Indian Trust Act 1882. And before moving on to other details, we have to understand first of all what is trust. So trust example is provided here. So here it's a illusionary example only. Mr. X is a person. He has a granddaughter, and for his granddaughter, a property is uh, within the Mr. X. And for the benefit of X granddaughter, this Mr. X will transfer the property to another third party called Mr. Y. For what purpose? So Mr. X may be saying that after his death, this property should be transferred to the X granddaughter. So in between that lifetime of Mr. X, the property will be hoarded by Mr. Y, that is another party. In trust contract, we may be calling them as trustee. So Mr. X is a trust who reposes confidence in Mr. Y, so he transfers the property to Mr. Y for the benefit of X granddaughter. So this trust contract is applicable to the mutual fund also. In mutual fund, a sponsor is creating a trust, and this trust beneficiary is the investors, and this trust contract is beholden by the trustee for the benefit of unit holders. So it may be a little more clearer with an example. You can see here that SBI Mutual Fund is a mutual fund formulated under Indian Trust Act 1882. This mutual fund trust is created or promoted by a sponsor, another entity called State Bank of India. So actually the owner of that mutual fund setup is State Bank of India, But for the benefit of the investors, actually who is holding that property, that trust contract or that property for the beneficiaries or unit holders is held by SBI Mutual Fund Company Private Limited. That is another entity, trustee. And in India, the actual management of the funds in mutual fund is done by another entity called Asset Management Company. So basically, there is a three-tier structure in Indian mutual fund scenario. So once again, sponsor is the creator of the mutual fund in the trust format, and for the benefit of the unit holders or the investors, mutual fund investors, a trustee is established. This trustee's duty is to protect the property of the unit holders or the investors, and the actual management or the fund management of the investors money is done by another entity called AMC, and actually the fund managers are employed by this third tier, that is AMC. In this example, that is SBI Funds Management Private Limited. Another example is also provided here. You can see and pause. Now we can see the basic concepts in mutual fund. So the first concept is unit. We have already seen. Unit means it's a undivided share in the assets of a particular scheme. So in the case of SBI mutual fund, there can be many schemes. So a unit means an undivided share in a particular scheme, or in the assets of a particular scheme. And the unit holder means the investor in that particular mutual fund scheme. So he may be holding different units in a particular mutual fund scheme. Now the another term is called face value. That means the original issue price of a unit of a scheme. Then NAV, the important element in the mutual fund scenario. So NAV means the market price or the unit price of a particular mutual fund scheme. So in our example, the initially we have seen that a rupee 10 unit, a rupee 10 valued mutual fund schemes are issued. So here the rupee 10 for a unit means the price or the value of that unit is rupees 10. Then assets under management, it is the asset size or the total amount of money invested by the public or the investors in a particular mutual fund scheme. And please understand, this asset size may changes. Why? Because the fund managers are changing their the money collected from the investors are in turn is invested in various financial assets, and according to the movement of these financial assets in the portfolio, the assets under management market value is also changing. So in a sense, asset under management formula is the current NAV or NAV into total number of outstanding units, or simply the total market value of the assets held by the fund managers of a particular scheme. And NAV means is the net asset value. So it's called net asset value because from the total assets under management, certain external liabilities are deducted, divided by number of units. So we get the NAV. So NAV shows the true worth or the value or the market price of a particular mutual fund scheme. So based on the changes in the NAV of a particular scheme, the return or capital appreciation is generated for a particular unit holder. So here is an example for calculation of NAV. You can see here, this is a particulars regarding particular scheme and you have to calculate the NAV. There is the value of stocks rupees 100 crores, value of the bonds rupees 40 crores, and the value of money market instrument rupees 10 crores, and dividend accrued but not received. So you can see all these things, and the number of outstanding units is also provided 2 crore units. And you can take a pause and find the answer. So the formula for NAV is nothing but asset under management, net asset under management divided by number of units. So here the number of units is 2 crore units. You have to deduct from the total assets, you have to deduct the external liabilities, then divided by the number of units, you may be getting the current NAV for XYZ scheme. So we can move to the answer part. The NAV for this scheme is 155 minus 1, that is 154, by 2 you get 77. So how we come? Here the value of stock is 100, that is the asset of the scheme. Then the value of bond, 40 crores. Then the value of money market instrument, that is also a particular investment, that is also an asset for the scheme. Then dividend income accrued but not received, that is a current asset, that is a outstanding income. Then interest income accrued but not received, that is also a current asset, that is outstanding income. Then there is a current liability here, the trustee and management fees payable. That's a current liability. So we deduct that external liability from the total assets. We get the net assets divided by the total number of outstanding units. You get the NAV. So thank you all. This is all about the introduction of the mutual fund. In the coming videos, we can see more elements or content of this chapter. Thank you.